Welcome to Looking at the Markets with David Modell. Sometimes people ask me, if I buy a stock, where should I set my stop loss and where should I take profits? So I'm going to explain that as simply and quickly as possible. Okay, so let's say this line in the middle here represents the stock price when you enter the trade. All right, so for example, we'll use Apple stock. Let's say you buy Apple stock when it's $120 per share, 120. Okay, so you buy Apple at 120 per share right here. Okay, so first you have to think about the maximum amount of money that you're willing to lose on that trade, and it should be a small amount. It should be 5% of your trading account or less. Better yet, if it's only 1 or 2 or 3% of your trading account, that's even better, because I believe in taking small position sizes per trade. But think about what's the most you're willing to lose on this trade without getting emotional about it, because you don't want emotions to enter into this. All right, so decide beforehand, commit to yourself that I'm willing to lose this amount without feeling emotional, without feeling fear or greed or anything like that. All right, so take that number, and now you're going to set your stop loss order. So you're going to take the stock price when you entered the trade, and then you're going to subtract the amount that you're willing to lose, and so you end up here at this line, and that's your stop loss order. And you can place an automated stop loss order with your broker. All right, so once again, your stop loss order is placed at, you take the stock price when you enter the trade, subtract the amount you're willing to lose on the trade without getting emotional about it, subtract that, and that's the price where your stop loss is going to be set. And you want to set that, right after you buy the stock. You should, or at the same time, set your stop loss order, and don't move it. don't avoid the temptation to move it down and down and down. Just stick to it. Okay. And so, for example, let's say you're buying Apple at 120 and per share, and the most money you're willing to lose on that trade is, let's say, $5 per share. Anything over that, and you're going to get emotional and fearful about it. So $5 per share is what you're willing to lose on the trade. Okay, so 120 minus 5, you would set your stop loss at 115 per share. Simple. Okay, then you figure out where to take profits if the stock price starts to move up and everything goes great. Okay, so what you do is you remember that amount you're willing to lose that you committed to. You decided you're willing to lose that without getting emotional. Take that number and take that amount you're willing to lose and multiply it by 3. For example, take that. In this Apple example, you take the $5, multiply it by 3, so $15. Multiply it by 3. Okay, so now again, we're back to, you take the stock price when you enter the trade, and now instead of subtracting, you're adding. You're adding that number, that amount you're willing to lose, times 3. You add that number to the stock price when you entered the trade. You add that, and that's the price where you set your limit order to take your profits if the stock price goes up and up and up. Okay, so in this example, you would take 120. You bought Apple at 120, and you're willing to lose up to $5 per share. 5 times 3 is 15. Add that to the 120, and you would set your profit target for 135. Apple at 135. Yeah, it's 120 plus 15. 135. And that's really all there is to it. And the hardest part for many people is avoiding the temptation to move the stop loss down, okay, and also avoiding the temptation to cut your winners short. You have to let your winners run all the way to your profit target, and you have to cut your winners. You cut your losers short, and you let your winners run. That's how you get that 3-to-1 ratio. When I say 3-to-1 ratio, when you win, every time you win 3 times as much as you lose when you lose. All right, and so but in order to make that work, you have to let your winners run. Avoid the temptation to take profits before it reaches your profit target. Let it wander around wherever it's going to go until it either hits your stop loss or your profit target, one or the other. As simple as that. Okay, and so you have to be unemotional about it and let the market and let the stock go where it's going to go. Now, what if? Let me tell you what's great about this method. Since you win 3 times as much when you're right as you lose when you're wrong, that relieves you of the burden of having to be right all the time. You can be wrong half the time, or even a little bit more than half the time, and still come out ahead over the long term if you have enough trades. Because again, every time you win 3 times as much as you lose when you lose. So you can be wrong quite a lot of the time, and it's okay. All right, you don't have to feel like you have to be right all the time. Now, that's if you're taking a long position, if you're buying a stock. What if you're shorting a stock? Then you reverse these. You put your stop loss above the stock price when you enter the trade, and that depends on how much you're willing to lose, and that's your stop loss. And then you take profits 3 times that amount below. All right, when the stock price goes 3 times that amount below. So you take this and you put it down here, and you take this and you put it up here. So your stop loss is here, your profit target is way down here, 3 times as big, three times as wide as your stop loss above. So you would just reverse all this for when you're short selling or shorting a stock. So I think I kept it pretty simple there, and it's very effective. That 3-to-1 amount you win to amount you could lose ratio, it's very effective, and it's very simple. It's a simple method. Okay? So I hope that was helpful to you. If you have more questions about it, if you just want to learn more about this, or if you have questions about trading, or you want to put together a trading plan or investing plan, I can certainly assist you with that. My name is David Modell, and my email address is davidmodell@gmail.com. And you can contact me at any time. If you like this video, please give it a thumbs up on YouTube, and please leave comments. Also, please subscribe to my channel so you can receive the latest updates on my financial educational videos. Thank you so much. I appreciate it, and I'll talk to you again soon.